How's it going, everyone? My name is Tony Velasco, and this is episode 17 of the Tony V Project. We are back for round two since my most recent one about a month ago after a long layoff. Again, trying to bring some added value to the listener and kind of talk about topics that can resonate with a lot of people. So I figured no better three guests than the three of you guys to discuss the age-old topic of whether or not your primary residence, your home, is actually an investment. And so we have Cheryl Insua here with us. She's been in the industry for 15 years and is with Realty One Group right now.
Yes.
Mr. Robert Clark, the guy who racks his own weights in the gym here. We actually all three Afterburn members, always pulling from our community here, but the regional vice president of Peterson International Underwriters. And of course, we have Pam Ingram, 2019 Woman of the Year, RE/MAX extraordinaire, 25 years?
Yes.
25 years. So quite the panel we have with us today. We're obviously going to dive deep into again, all of the statistics. Hopefully these guys brought some good evidence to back up your arguments. We may bring out the gloves and go to blows. I give the edge to Pam.
In the car.
Kickboxing up.
Yeah, right.
My money's on Pam too.
But before we get to the fun stuff, why don't you guys kind of do a little round robin, introduce yourself. Cheryl, why don't you start us off?
Cheryl Insua. I've been in the real estate industry for about 15 years. I started out as a transaction coordinator, working with a lot of top-level brokers in San Fernando Valley, in West LA, and now in Santa Clarita. Been full-time realtor for 5 years, and I couldn't be happier. I love what I do.
Right on. Very cool.
I'm Robert Clark, and like Tony said, I work for an insurance company. I have no professional experience in real estate, so that's kind of interesting. I think I'm going to get a little bit beat up here. But I've been in insurance for 7 years, and just a lot of that is obviously looking at finances, risk management, things like that. So a topic like this are things that I've talked about in general with my own audience, and so I'm delighted to be here.
Right on. And third time?
Third time on
the show.
Third time.
Wow.
Hopefully, I'm going to make it this time.
I know,
the
right?
first two, none of the post-production staff caught me, so we're recruiters from like NBC, ABC, but this is the one, third time's the charm.
That's right.
Today's the day.
I feel it. Your mom didn't. You asked her to share it on Facebook. She didn't get the word out.
She doesn't know where the button is. Yeah. She's still.
Hi all, I'm Pam Ingram. I'm with RE/MAX of Santa Clarita. I also started off as a transaction coordinator out in Westlake Village and became an office manager. Then when we moved back out to Valencia, I joined RE/MAX, and I've been there for 25 years. I achieved Lifetime Achievement Award and Hall of Fame. And as Tony said, this year I'm Woman of the Year, but that's not for real estate. That's for my philanthropic endeavors in Santa Clarita.
Very
cool.
commendable.
Right?
Yes, absolutely.
Yeah. Quite the panel here. So super excited. Very three knowledgeable and experienced individuals. I'll preface my kind of point of view before, or your like malleable point of view of what you said in the email. I'm torn, right? I'm torn in the sense that there's some part of me that from a strict investment standpoint, I have my hesitations to dive right in and believe all in it. But at the same time, I'm a homeowner. I just purchased a new home. I will always own my own home. So my viewpoint is I'm someone who, like, regardless of whether I think it's like how great of an investment it is, I've always believed that if you want that security and control of your own home to not have to be kicked out, you know what I mean, when your lease expires by whoever your landlord is, like at the very least, like having that or being able to sleep at night because of that is worth $1 million in and of itself. So, but let's get to the other stuff. Why don't we we'll kind of round robin it and kind of give your overall opinion, and we'll just kind of dive into it and see what happens.
I will start because years ago, 1974 to be exact, I was buying my first home in Santa Clarita. My parents were looking at a townhome, and my father said, absolutely not. He was not paying $20,000 for a townhome. I have that same home listed today for over $400,000.
Wow.
So real estate does improve over time. There are pockets of time frames when the market goes down, but it always goes back, and it always goes back higher than it was before. So I firmly believe it's an investment.
Very cool.
Interesting. I like it.
1974. Side note.
Yeah.
I didn't even know there were homes. Like, I remember like the 80s, it was like orange, wasn't it like orange fields? Like where like Bridgeport is?
When we moved here in 74, you had Tips Restaurant, you had Lumber City, you did not have a hospital. You had a 76 on Lyons, and that's about it.
Saugus Cafe.
There was Saugus Cafe around?
If you wanted dinner, you had to go to the Backwoods Inn.
Wow.
Is that the one down? That's not Bouquet.
Sierra.
Sierra.
Yeah,
Okay.
Sierra
Yeah.
Highway.
Yeah.
I'll second off of Pam over here. And also touching a little bit on what you were saying about the security of being able to know that no one's going to be able to take your home aside from the bank if you don't make your payments. But I just recently closed escrow for a client. He's in Palmdale and was commuting out to San Gabriel Valley to take care of his grandchildren. They were in a rental, and all of a sudden, and it was the second time it had happened to them, the seller decided mid-lease that they were going to sell the home, and they would have to find a new place to live. They have 3 small children, and so it's hard for a family in that situation to uproot and move when you have no real sufficient notice. And so he pulled the equity out from his own home and was able to use that as a down payment and bring them closer to him in Santa Clarita and buy a home out here for his family. And now they don't ever have to really worry about going through that stress of, where we have to find a home, what are we going to do, like transferring their kids into a new school. So I agree. I definitely feel it is a beneficial asset to have.
This is one of the slogans that I use. If you rent a home for $1,350 a month for 30 years, you've spent $486,000 on something you will never own.
You should up that for current inflation, current
Yeah.
cost of
Well,
living. That number would
You
look a
can't
lot
rent
better.
anything in Santa Clarita
No.
for that price, but
No.
yeah.
Yeah. So that's one of the things that I think about, and for the purpose of agreement, I totally agree that purchasing a home is an investment, but it also depends on how you define investment and the investor's expectation of what that investment will do. So for instance, the down payment on a property that you could afford for that $1,350 a month, would that be better over those 30 years? Would that grow more than that $486,000? That is merely where my math, I've done a lot of the calculations on my end, and I'm like, it depends. For the not so financially savvy investors, it's a great investment because they don't know where to put their money to get more than a return like that. But if you're someone who, let's say, owns a business or does, participate in the equities market and the stock market and can return more than the average, 3 to 5% a year for real estate appreciation, you might actually be better off renting and investing your capital elsewhere.
But you have to be diversified.
Absolutely.
Whether you're in real estate, whether you're in investments. If you're in investments, you're not in a single portfolio.
Right.
You are going to be diversified. And a house is just one of those items that you would be investing in. So it's not an all or nothing with real estate.
I agree.
See, my thing is, and I'm kind of in your line of thinking, Robert, in that for me, it's literally the investment thing. It's I obviously wouldn't put in the same category as a car, because a car's, in addition to paying interest and everything, the car's value also depreciates, whereas a home's value actually appreciates over time. So it's definitely not in that category. But I would put it in like this weird middle ground where there's like, you know, I don't like, what would you call? Because there's liabilities and assets, but then what would you call like a TV? Like something that just
A consumer item.
yeah. Okay, so
A
maybe there's a
novelty.
few different categories. There's like consumer items that are just there. You have depreciating assets. You have, you know, appreciating assets, but that have some sort of liability element to them, payments, insurance, all of that kind of stuff. And for me, like the home aspect, it's the $200,000 or $500 or $100 or $50, whatever it is that's that down payment. I actually tried to do the math when I knew we were going to have this talk on would it make logical sense to pay PMI to be able to keep whatever that down payment would be, and it doesn't, because by the time you have to back in, like PMI is 1% of the value of the home a month-ish, correct?
Right.
You would have
More or
to,
less.
just to break even on what you'd be paying for the PMI, if you decided to keep that 100,000 or whatever it is for your down payment, you would have to, I think it's like 5 or 6% you would have to make just to cover that.
Right.
And then anything above that, and at that point it's a waste of time.
Okay, but be a devil's advocate. You put all your money into the stock market, and it fluctuates like the stock market does, and the real estate market does also. And you're renting. If you're renting and you're in the stock market, do they ever level off? I mean, that doesn't make any sense to me, to rent a home and put your, what would have been your down payment, into stocks. To do both makes sense, but for the person that can't do anything, does it make sense to rent and only be in the stock market?
Right.
Is your question, just so I can understand it correctly, in theory, that rents are identical, like what your mortgage and all that stuff, like home A and home B, one that you're renting, one that you're buying, that it's $1,350 payment-wise for both of them, but the $200,000 you're using for the down payment over here versus $200,000 that you're putting in the stock market, is that the comparison we're talking
That's
about?
what I
Okay,
would say.
okay.
Would you give up buying a home and put all that money into the stock market? Would it ever equal out? Because now you've lost the equity on the home over X number of years.
And also, if you're putting all that money into a home as opposed to the stock market, it's a physical asset that you're able to utilize every day, that you see basically where your money went. Stocks, you're not really able to do that with. It's just a risk, it's a game, just hoping the stocks don't, plummet and you don't lose all of your money. At least in a home, it's something you're utilizing every day. And like you said, even with renting, you're never going to rent exactly unless you have an angel of a landlord that is evening out on what their mortgage is. They're not going to let you, and they're going to take in consideration the cost of maintenance and everything like that, and they're going to add that on to what the rent is. So you're never going to be paying just an even out landlord's mortgage. There's always going to be some additional costs added onto your rent. If you're having your own home, at least you can take into consideration of what side money that is going to be spent on maintenance, on when that time comes, on how much you're going to invest into it at that time. Or as, owning a home, it's a lifetime of maintenance and upkeep and things like that. But at least you make the decision of how much money you want to put in increments to obtain and maintain the home as opposed to when you're renting, they're just taking that cost. Whether you wind up using it or not, they're going to have it. And you're helping them pay their mortgage and helping them gain equity so that they can pull that extra money and go on vacation, buy a second home, or whatever they decide. So I think, it's another way of or put it in their own stocks or whatnot. So I always think that, owning, especially with how much homes have appreciated even in Santa Clarita in the last 5 years, if you're to have PMI in the beginning when you buy a home, my husband and I had it when we first bought our home, and within 2 years, our home had appreciated that much. We were able to remove the PMI because we had the equity in our home, and now we don't have that extra payment only after 2 years of living in the home.
Yeah.
So PMI is not permanent.
Right.
And with the rate that homes have been appreciating, it's something that you can, pay for maybe a couple of years, and then with the way the equity has been, accumulating in people's properties, that can just go away in, like I said, in a few years.
Well, and I think that's the difficult part of this debate is the primary residence. Like I think everyone here would agree with me that when if you were to talk about commercial real estate, some sort of like an income property or even a residential property that you then rent out, that's income, they're paying for all of your liabilities and expenses associated with it, it's a no-brainer, no question, one of the best investments around. The debate on your primary residence is difficult because it's not as easy as, it's not an apples to apples comparison because of what you said, which is that unless you plan to live in the street, you have to live somewhere.
Right.
And so it's not like it's as simple as like have a house to live in or invest in the stock market. It's have a house. It's how do I explain this? I guess my point is the $200,000 that you would put as a down payment versus invest in the stock market. Even if you invest in the stock market, you still have to go rent somewhere. So there's an added expense on top of that potential comparison investment that factors into it.
Plus, you're giving up the tax write-off. Mm-hmm. The only thing you can write off is your taxes on your house. I mean, California has gotten to the point that we've limited how much you can write off as far as your property tax and the interest on your home. So the stock market, you can't write off.
Right.
And even if you work from home, you can even write off a space that you work from within your home.
For sure.
And that's just another tax advantage that you could have.
My only counter to that, though, is this. I don't think that's a fair comparison either, a write-off in the stock market versus a write-off on your residential home, because the write-off is associated with the interest you're paying as a liability on the home, and there is no interest or liability that you're paying in the stock. You're not paying, if you invest $200,000 in the stock market,
True.
You're not then also paying interest while your money's there. And let me throw out I know we all got some numbers here. Let me throw out a few to kind of get this party started here.
I'm just saving up all of my ammo.
You are?
Are you?
I'm, like,
I'm a little
sitting there
worried.
just like, okay,
I'm waiting.
making my
Hey.
mental notes.
Thou who speaks first loses.
That's right. That's right.
So Robert knows what he's doing.
No, not really.
So that's the number I got. You said it earlier, 3 to 5%. Even if we put
Increase in values
correct
of the
per
properties.
year,
Yeah.
annual increase in value. So if we just call it 5 or whatever for easy math. My thing is that I think there's a handful of things that factor into. Because again, my thing is not that you shouldn't buy a home, because I 100% think you should buy a home. It's the thought process to me of whether or not it's actually an investment, where that it gets a little gray or blurry for me. So if we think about, okay, it's going to appreciate 5% annually. Let's take the inflation argument out of there, only because that accounts for every investment. So if you invest in the stock market and it's appreciating 10%, the inflation devalues that investment too. So that's a control across the board. So I don't think we should count that. There is you're obviously paying interest now on that investment. And I don't know the numbers. Obviously, they're amazing now. So
Right now,
I
interest
can't imagine
rates
if
are
you
the
were like to
lowest
buy
they've
in the
been in a
80s
couple
or
years.
whenever they were when they were like 26%.
Yeah.
Like that would, that's crazy to me. But so that the interest that you're paying on the house would pull from that 5% appreciation per year. The other thing is I looked up some numbers on how long the average person stays in their home. Because I think if you were to buy a house now and stay in it for 20 years or 25 years or some, like people used to, right? Like you buy a home and you're just in it. Now people move more often. And the more often you move, the less you actually get of all that appreciation, because there's transactional costs from escrow and obviously real estate agents and stuff like that, which also pulls away from that bottom line net investment that you're getting. And I wish I had like a whiteboard we could actually like draw up the numbers. Maybe Robert's got them ready to rock and roll, I'm not sure. And then obviously you have, tax insurance and upkeep. And I think there's some argument to be said there, kind of like Cheryl said, that, I mean, in one way, shape, or form, you may not be paying the gardener. If you're renting, you're just paying a larger fee maybe to the landlord, that they've kind of built that into the price. But outside of those few things, outside of the transactional costs, depending upon how often you move, the other thing is that I have semi trouble kind of wrapping my mind around when we call it an investment is the interest liability payment aspect. Because outside of the value of the home appreciating, it's essentially a net loss on like a monthly income revenue side because of the interest that you have to pay. And there's literally not that I can think of, and I didn't put a ton of time into this, there's not another investment where running in the red, essentially on a monthly basis, that anyone would consider, like, yes, the value may go up and down in the stock market, but there's not a monthly cost associated with having your money in the stock market. There's not a monthly cost if your business, you know what I mean? If you were to invest $200 in a business and that business was in the red every month, that probably wouldn't be a wise investment. Right. So it's those two things. It's the monthly cost associated with the financing aspect of it, and the transactional cost depending upon, if you stay in 25 years, you're good. If you're moving every 7 to 9, which I think is the average, I mean, I think it's roughly 10% if you look at front end and back end. The purchase of the home, the costs that go into the purchase of the home, and then the costs that go into the sale of the home, it's around 10%. So if you appreciate 5% a year for 5 years, it's going to be more than 25% because there's compounding interest. So let's just call it 30. I'm just throwing out numbers. Yep. If it appreciates 30, right, well, 10% of that is going to be gone to transactional costs. So now it's only appreciated 20%. If you take into account inflation, just for this thing, of 4% a year times, I think it's let's call it 3%, for 5 years is what I did, right? So that's 15%. Yep. So that's 15 off of the 20. So now we're really only at a nut 5. Right. Is 5% over 5 years, like bottom line net, like a percent, like that's where, like, okay, yeah, you're still in the black in terms of like you're ahead of where you were, but is it really generating like bottom line wealth when you factor in all the other expenses? Right.
I think it depends on, like you said, how long you stay in your home, how much equity your home, accrues, and then what you're going to be using that money for. So if you're taking the equity of your home, in the case of like what my client did, they were able to buy a home for his daughter and her family, and now he lives closer to them. So for him, it was a great investment when he purchased his home because it allowed him to now buy a home for his daughter down the line. Now, like you said, if you're moving every 3 years or whatnot, I wouldn't suggest buying a home because you're not allowing your home to gain the equity that it could potentially make. If you, like you said, if you're living in your home for, I pulled for even just Santa Clarita alone, it's 12 to 14 years average is what they say before a family moves. That even in the time frame, even in what we've seen in the last 10 years, that would give your property substantial time to gain enough equity to either take from that and either buy a second home or take the funds of what a home that you bought 10 years ago and what it's valued at now, take the profits from that and say in the last 10 years you've gotten married, you've had kids, and now you're able to buy a bigger home that now suits the lifestyle you're living now. So 10 years ago, you bought a starter home, it worked for you then, but now you can take the money and the value of the appreciation of what that home has gained in the last 10 years, and now it can help you to fit the lifestyle you're living now and the home that you need for now. So that investment of what you did in your early 20s, say, and now you're in your early 30s, to me, was a great investment.
Yeah.
The only issue that I have with that, with making sense of it through that way, is most people, they buy the starter home because they're like, oh my gosh, it's the perfect starter home. Oh my gosh, I want it so bad. I'm gonna paint these walls
We're all
gray.
about the feels.
And I'm gonna put light gray tile and granite countertops, maybe not granite. And then they start the family, they raise the family, they want to upgrade to that new home. Fortunately, there's likely appreciation that allows them to leverage up. But again, they're making an investment based entirely off an emotional decision. Oh my God, Susie's gonna have her own room, Brad's gonna have his own room, we're gonna be able to swim in the pool together, and all these extra things that's causing them to overextend on the investment. For me, that's the biggest piece of the puzzle here, is that most buy a house that they think they can afford, and it overextends them financially, and that's where they get put 5 steps back 10 years from now when something goes wrong, whether with work, whether with their health, anything like that. What most don't talk about is it's fantastic to pull equity out of your house, but you have to be in a financial position to now up your payment based on the equity that you're pulling out, right?
Sure.
It sounds awesome for a dad to go buy a house for his son or daughter that's getting kicked out. But what no one's talking about is that extra $1,000 or $2,000 a month, that new capital is costing him now for the next 30 years or until that HELOC's paid off.
Well, and I'm sure Pam would agree. As a realtor, one of the first things I always talk about with my clients is making sure you're not buying too much home,
Right.
so to speak. That you've already spoke to the lender. Whether you've been approved for a $700,000 home, are you financially ready and capable to pay for a $700,000 mortgage?
Right.
A lot of people say, okay, even though that's what I'm approved for, I only want to spend this much a month. And that's one of the first conversations I have with all my clients. Make sure that when you speak to your lender, you tell them how much you want to spend a month. They may say you have amazing credit, your debt to income ratio is low, so you can afford this much. But honestly, buying into a home, say you also like to travel, you have a certain school that you want your children to go to or a certain lifestyle you want to obtain. Make sure that when you're buying a home, those monthly costs conform to what your lifestyle is. And that's, I'm sure, something you have that conversation.
I agree with you. I also have seen what you're talking about many times. I've had clients that push it to the limit, and I have said to them, your life is perfect right now. Lives don't stay perfect
That's right.
for a lifetime.
That's right.
And you've got to consider a child getting sick, husband losing his job, all those various factors. Some do, some don't. Some believe that in this perfect world, everything will stay perfect. And I've been married for 47 years, and I can tell you it doesn't stay perfect for 47 years. There are good days and there are bad days, and there are things that have gone perfect and there's things that have not gone perfect. Younger people, the millennials, the young people buying their first time home, don't look at okay, they don't realize that there could be a bad day. They're not looking at that. I still do believe whether it's the best investment that you'll ever make, it is still an investment. Right. And the alternative of renting for your entire life as opposed to owning a home is not a wise investment.
Unless you can make 15% on your money. That's just a calculation. I mean, it's all speculative.
Well,
but the numbers that I've run, it seems like that 14 to 15% interest on the down payment is where you start to see a big sway towards renting.
Say that one more time.
So the down payment you put on a home, if you stayed renting and you invested that down payment and were able to collect 14 to 15% interest for those 30 years, very speculative. And that's also including 2% rent increases while you're renting, which are also very speculative because I know they've been higher like in the last 12, 24 months. But if you play that scenario out, it is way in favor of renting. When you get below...
That's when you factor in all costs on both ends,
Yep.
everything?
Taxes.
But when has the stock market stayed 14% for 30 years?
Yeah, I'm not a fan of the stock market, trust me. I said that in the beginning, but yeah. No, I agree. The stock market
not that
has
the real
it.
estate market doesn't crash, because
Right.
it has, and when it
Is
comes
it coming?
back,
It's got to be coming, right?
it's coming.
It is.
I mean, it's got to come. Eventually, it's got to come. But
We've
knows
been
when?
riding high for, what is it, 8, 9?
yeah, but
Is it 10 years?
usually you don't have a crash in an election year. So we're going into an election year next year. So usually
Really? I
the
didn't know
stock
that.
market and the real estate market don't usually crash in a election year. What president wants to see
Right.
everything crash? So
Especially not
everything,
this one.
yeah, especially everything, and then you're looking at, depending on who gets into office, what will happen
Right.
the third, fourth year from now. The next year and the year after should
We should be good.
We should be good. But my crystal ball is always foggy.
I know.
But
Pam said it.
Yeah,
You can invest.
2 years,
Yeah.
you got it.
Yeah.
there's also the emotional part of not owning your own home.
Right.
What can I? Because I totally agree that there is a huge emotional side to owning your own home, and maybe it was the way that it was pitched back in the 30s, 40s, 20s, or whenever we did it. But why do you think it is? Because I think we're one of the only countries that, like, I don't know what the percentages are of home ownership here versus, say, the UK, but I know we're higher. I know we're way higher than almost any other country. Why is it that we're so emotionally invested in that here?
Because for a female and some males, I would say, you put your heart and soul into decorating a house,
The community.
making the yard what you want, where you want your kids to play, what street you live on, what school they go to, the community you live in. It's a vested. Not that you don't do that if you're renting, but you don't tend to take care of a rental the way you do your own personal property. It's the same as a car. If you're out on vacation and you rent a car, if you go over a few speed bumps, you don't care. But at home, you go very slow over those speed bumps when you own the car.
Don't
And
rent a car to Pam.
I didn't say I ever did that.
Yeah.
But
This show is so big, you're going to go to Enterprise. You're going to be like, no, we saw the Tony V project. We saw when you do cars. You've been flagged.
You're blacklisted.
yeah, my Hertz is now on hold. But you know, it's an emotional thing to own a home. It's an emotional. There's a lot of things that go into that part of it. Like I said in the beginning, I believe people have to be diversified. Whether it's a business, whether it's stock market, whether it's owning a home, you have to have your fingers in everything.
Totally agree. And you brought it up earlier. I didn't get to talk on it. So it makes perfect sense. Any investor knows it's good to be diversified. That way, if one takes a huge loss, you're not totally absorbed in it, right? But what we are asking people to do when they have $100,000 saved is we're saying, hey, you should buy this house and stick your 100 grand into one investment, one asset, one home that hopefully the foundation isn't broken, hopefully the water main doesn't crack, hopefully the gas pipes don't crack, and you didn't buy the Southern California Gas Company's warranty and all these things. We just stuck $100,000 into one asset, one stock. And
True.
so we're subject to just as much loss. Now, I know you're not saying that, and the right person should have some stock, maybe some real estate rentals, and then their primary residence, right? But I think a lot of people get into this idea of, I'm going to buy a home, that home's going to appreciate 5% a year, and it's going to be my retirement 30 years from now once it's paid off, and all of these things. And it's just like, that picture is not so pretty, because again, that's a perfect life.
Well,
Let me ask you a question, because you own your home too, correct?
Yeah,
Okay.
absolutely.
What would
You
you
want to see my expenses?
would you say that a perfect scenario? Because I'm assuming that. So let me ask before I assume. Would you have ever not owned your home?
Ever not?
Like, would
owned my
you
home?
prior to you purchased it,
Right.
knowing
Considered
what
otherwise.
you know now? If you could go back in time, would you not have purchased it, or would you still have purchased it?
No, I would have purchased it, because I would have, had I not purchased it, I never would have second guessed homeownership. So by going through that process, at some point I started to think like, man,
you learn through experience,
it
kind
would
of.
kind of be easier to rent at this point. But I mean, everyone's in a different situation. I'm in sales. I am compensated based on how many people I meet, how many people I talk to, how many people I help. Do I want to live on the same block for 20 years when I could, every 1 or 2 years, go move to another block, meet another 30 people, go move to another block, get another 30 people, and you're just opening, the American dream was sold of, oh, we're going to have these neighbors, all of our kids are going to be raised together, grow
Block
up,
parties.
be lifelong friends, block parties. And I agree, there is a need and a desire for that in today's families, but a lot of people are closed-minded to what other opportunities are out there based on where I live, who I get to meet, where I can travel to. A lot of people are living internationally for a year. Mm-hmm. If you own a home and you don't know if you're going to come back, you don't necessarily want to sell that home if it's going to be, mid-short term. And so, but then all your equity and all of your assets are tied up into this house. So if you rent, you're nimble. You need to go to LA, you need to move to San Francisco, you want to move to Morocco, Spain. Look at how many 65-year-olds are now choosing to rent versus buy another home, and that will tell you what homeownership has created in their minds of, oh my gosh, I have this thing that cannot seem to run perfectly for a year. I'd rather just go rent, try out 4 different communities in the next 5 years, and see where I want to land.
I'm going to do a quick spin and touch on 2 things that we were talking about. One, I think owning a home is an investment, and yes, there are financial risks because you never know when something's going to break or something's going to happen. But I think that's with every investment. If you invest in a car, you never know when the gasket's going to blow or you're going to need a new engine. If you invest in the stock, you never know when the stock's going to plummet, when it's going to rise. If you invest in a business, you never know if it's going to be a good month, if you're going to have nobody sign up with your whatever you're selling. There's always going to be a financial risk to whatever an investment is. That's just how it goes. Right. Second, I just recently helped my mom buy a home who was renting in South Pasadena in a beautiful home, and the rent was increasing. She was there 18 years, and I just helped her buy a house. She retired and is paying less for her home than she was on her rent. Yeah. And on her rent, there was only so much she can do to her home. Now she's planting gardens, she's doing anything and everything that she wants in her home. And it's the home that she's going to be in for the rest of her life that she wants, unless me and my family move, then I know she's going to follow us because she wants to be close to her granddaughter.
Exactly.
So, and that's the emotional aspect. She moved out here to be closer to me and her granddaughter and to be closer to her family, just as my other clients did. So there's always going to be, you know, an emotional attachment, a financial risk, but in the end, you know, if you own a home, doesn't mean you can't go travel. With the way we have society doing Airbnb and, you know, vacation rental by owner and things like that, if you own a home, there's no saying that you can't leave for a year and go live abroad and not utilize that home as a rental. I have a friend that did that in Pine Mountain Club, you know, bought a home out there and then rented it out when her and her husband were traveling across the states.
Was it their primary residence?
Primary residence.
Yeah.
It was
But
where
you
they
can't do
lived.
that in all of Santa Clarita.
Right.
Some of the
There's certain
HOAs
places, right?
don't allow it.
Well,
Yeah.
Interesting.
yeah.
Yeah.
But it's still an option out there
Right.
for some homeowners
Right.
if they did choose.
I just sold a condo and we actually didn't end up closing because he was already committed to an Airbnb and he couldn't get out of the contract. So, yeah.
Really?
That's
Yeah.
crazy.
Like he was renting one for like long term?
He was the owner. He had it rented through Airbnb.
Oh, and they have contractual agreements?
Yeah.
For how long? I didn't know that.
Yeah. All right, well, that's what he told us.
Yeah.
That's
Huh.
interesting.
One of the things you mentioned, which is interesting, when my parents were younger, the idea was to buy a home and own a home. Now they moved a lot when I was young, but still the ultimate goal was to own your home.
Right.
I was in Sacramento a few months ago and we were talking about the situation in California because prices have gotten so high that the younger people cannot afford to buy homes. And I suggested, and I was surprised that it came as a shock to some people, that we need to stretch the loan out to a 50-year loan.
Oh my gosh, this is so. I was
And
literally just.
the
going
reason
through this.
is that the younger people cannot afford to buy a home in California right now. And even on a 30-year loan, even with the low interest rates we have right now, and they're only putting 5% down, or in some loans 3.5% down, they still can't afford that payment. So the reality is that the millennials, younger people, I don't want to just tag millennials, but younger people want to own a home, want to have that investment, but at the same time, they buy based on what their payment's going to be. So the only way that we're going to be able to help first-time buyers in California is to stretch the loan out to 50 years. And then
No.
does it become a good investment? Probably not.
No.
Well,
But
don't you think this is my thing that I struggle with? Like, because there's been lots of stuff on the news about
Can it?
like rent prices are so high, and you have these people on Channel 4 News, and they're like, you know, giving the sob story about how they can't afford rent. Like, it's called Econ 101. It's called supply and demand. This may sound like heartless or whatever you want to call it, but like, then that just means you can't afford to live in California.
Yep.
yes,
Like, it just means go to Texas or go to there's some other amazing places, not as amazing as California, but you have to go where your
Dollar can go the
dollars
farthest
can
for
go
you.
the furthest for you. And so sometimes it's got to be like, this is reality. You
And
know
a
what I mean?
lot of
We can't
seniors-
just have what we want. Like, I want to live in California. I want it. Like, too bad, so sad sometimes.
Right.
I actually know of quite a few people that have moved out of
Yeah.
Yeah,
state.
so yeah.
Because-
And
A lot of my
there's a lot
clients-
of people
Yeah.
that are moving that
Yeah.
direction
a
now.
lot of my older clients are selling their homes
Yeah.
and they're moving to various places. I mean, it used to be they were all going to Nevada, but that's not the case anymore. They're spread out to Idaho,
Yeah,
Texas.
Arizona,
Arizona,
Utah,
yeah.
Oregon.
I even had one that moved to Missouri. I'm not sure about that, but he did move to Missouri.
It's bold. So I have a big theory that, you know, we talked about in 1974, the house was purchased for $20,000. Mortgage interest rates were 18 to 20%.
Actually, when I bought my home in '74, it was 5.5%.
Was it really?
Wow.
So what
That's
the
phenomenal.
heck happened in
Well,
the-
then it went up, and I mean it's come down,
Yeah.
and
Right.
I mean interest rate fluctuates a lot,
Right.
And that's based on the president and
Right.
Yeah.
Yeah.
Yeah,
You know.
for
The
sure.
economy
Yeah, there's a lot of
and
politics
unemployment
involved in that.
rate, and
Yeah.
Yeah.
it all plays a
yes,
My big theory is that, and I didn't create it. Sorry, I don't mean to come up like I'm some philosophical genius. I really honestly think home ownership, the idea that we're all sold that we should own a home, that it's the American dream. I believe the home ownership idea was sold by banks because banks
100%.
are the ones that are benefiting from all of us trying to own our own home.
100%.
Right? If you outlay how much the actual expenses are over 15, 30 years, it's ridiculous. And so my theory is that's what has allowed real estate to appreciate 5% a year, is because things that get capital like that, those tend to grow faster because now they're more accessible to more people, supply and demand. I was right before you said that, I'm literally sitting here thinking, and I'm like, just wait until they offer a 60-year mortgage option, because it's the same in car financing. What used to be 60, 72 months is now 84, 90. I mean, it's ridiculous.
Yep.
And my only concern is that people buy a home with a 30-year mortgage because they could not afford the 15-year mortgage payment.
yeah.
And so I feel like it's going to be the same. They shop on payment, right? I can't buy that home at 30-year mortgage, but if I do a 50-year, now I can afford it. So they buy too much home, then life throws its curveballs at them, and that's when people get
It's
sunk.
like the same thing as like the diamond industry. I forget when it was that it occurred, but like they ran that huge campaign X amount of years ago about like the percentage that of your income that you need to spend.
Yeah.
I forget what it was. It was like 10% or 5% or 20%. Like, but that was like a part of the thing, and that's now what so many guys use as the benchmark
Yeah.
for how much they should spend on their fiance's diamond ring.
Exactly.
And that, you know what I mean, a diamond is forever. And like,
Right.
I mean, it wasn't,
Yep.
it was the diamond companies that,
Yeah.
that marketed it.
But I've also heard
Bastards.
I
That's-
know, yeah.
that also is another financial investment that that they sell you as a long-term investment, that this is something that's going to stay in your family, that you will pass down to your children so that they can propose to their wife or get proposed to by their fiance, and it's sold as a lifetime investment, just like
It is. It's
a home
marketing
is.
genius.
Yeah.
That's why they say, look, if you're going to spend this amount of money on it, don't just think of it as, oh, you're spending this much and it's a short-term investment. This is something that you're going to be able to look at and see and know that it's going to stay with you, and there's that emotional attachment.
This sounds oddly familiar. I feel like my wife tells me all the
Yeah.
time, like, I want this purse. It's an investment.
It's
I'm
an
like,
investment.
what?
Purses
Value
are
will
an
never do that.
investment.
So
If
that's
it's a good quality purse.
so what's interesting is, yes, fine jewelry and home ownership, both are what we've concluded to be very emotionally sold investments, right?
Assets, yeah.
At no point are they saying, hey, right before you croak, make sure to get that ring, go take it to
An appraiser.
an appraiser and get your money back, and it will have appreciated 10%, over 80 years. It's like they sold you the idea. They know you like the word investment, but at no real point are you exiting that investment. I feel the same way
Well,
about a home.
Even the stock market. I'm gonna quote my favorite movie of all time here in a second, Wolf of Wall Street. but I mean when God, what's his name besides Leonardo DiCaprio? I'm drawing a complete blank. Help me out here. In the restaurant, at the very beginning.
I'm the worst.
The short guy.
Matthew
Yeah.
McConaughey?
Matthew McConaughey.
Yeah.
When they're having that thing, not only does he say nobody knows what's going to happen in the stock market,
Right.
least of all stockbrokers.
Right.
But he also talks about just that, about the idea that like the investment, like they don't want you to take your money out. Like they said, like you pitched this idea to the people that are buying stocks. Like, look, you're gonna get 5%, 10%, 20% appreciation on this stock, and then they want to pull their money out, and you're
Yeah.
giving them the next
The
best
next best
idea,
yep.
so that you can keep their money, because that's how they make their money.
Yeah.
And so it's it's all the same across all investments.
But that's business in general.
100 oh, for sure.
I mean, even
For sure.
the gym. I mean,
Yeah.
if somebody comes in and doesn't want to be at the gym anymore, you're going to try and talk them into a better class, a different way of using the gym, how it's going to.
The
I
next
mean,
best
that's
thing, give you a
right.
donut so that you gain the few pounds that you just lost,
shake.
so we get you back in
That's
next
why
week.
you have the samples on the way
The
out.
shake.
right.
That's
That's why your shakes are so good.
That's right. I will say, and I pulled this statistic up, in 2018, 2.7 million first-time home buyers bought home.
In 2000 what? 7?
2018.
Wow. Well, I
Now,
say
that's
wow, 'cause it
not
sounds
California.
big.
That's
That's
across
the
the
country.
United States. 2.7 million first-time home buyers entered the real estate market.
That's crazy.
Yeah.
And in 2013 to 2016, 45% of them filed bankruptcy because of an unaffordable mortgage or foreclosure.
Yeah. What
That's a lot of
I
millions
firmly
too.
believe when you buy a home that it is not a short-term investment. Now, HGTV has promoted flip and fix,
Fixer
flip, whatever
upper,
they
yeah,
all are.
yeah.
And I have family members that flip homes. Right now, it is something that you can do. That's not always the case. You have to plan on living in a home for 5 to 7 years, and you've got to be able to withstand when the market drops, and it will drop. It will drop again someday, but when it comes back, it always comes back higher than it was before. But you can't say, I'm only going to live in this house too. I said that a few houses ago. We bought the house. We didn't really like it. The market was going crazy. We were only going to be in it for 2 years, and we were there for 14 years. You know, you've got to plan on staying in a market and being able to withstand
Ride
the
it
good
out.
times, the bad times. And if you want it to be an investment, you got to sell it when the market's high.
That's right.
Yeah.
Exactly.
What would you say, because we got to get close to wrapping up anyways, but to those listening, so right now, what is the general percentage of income that you say that like is the high end, but that you would say most people put towards like, okay, like I'm going to buy a $300,000 home because that's 30% of my income. Is 30% generally the number that's kind of the top end?
I think it would depend on, that's one of the things the lenders look at is your bank statement and
For
your
sure.
debt to income ratio.
I guess
so
I'm more looking
overall
at
debt.
but what you see is like the average that
It
people
used to be
do.
between 25 and 30.
Okay.
But we're going back to stated income. We're going back to bank statement
Yeah.
loans. You know, never say never in real estate because this is what crashed the market before, and we're seeing them coming back.
They're doing stated income.
Yeah, there's
Oh,
so
yeah.
many entrepreneurs out now that don't
California
go by a
especially.
W-2 that
Yeah,
bank
but don't they
that
go by
most
tax? They still use
no,
your taxes.
no, they will look
They
at
don't
your
even look at your
they
taxes.
will
So
just
who's
look
listing my
at your
house for
bank
sale is
statement.
what I want to ask.
I'll give you my card once we leave
Thank
here.
you.
And I'm there every Saturday.
Yeah, that's right. Yeah.
I didn't know
No,
that.
yeah, that bank statement loans are actually becoming quite popular
Yeah.
right now because entrepreneurs are becoming rampant.
It's very hard in California if you are a self-proprietor we don't want to give all of our income to the government. And if you don't claim anything, then you can buy a house. If you claim the deductions that you're allowed, you can't afford to buy a home.
Yeah.
Right.
So they are now looking at bank statements
Yeah,
again.
and they won't even look at what you're writing off, more at looking at what your total
Now it's
income
a
is.
higher
Yeah.
interest rate. A little bit higher interest rate, but they are coming back. And
So,
we never
What
thought.
would you say then? Because what I was trying to get at is, if it used to be 25 to 30, but and it's been a huge part of your argument that like stay away from that 25 to 30. Like it's not so much as like, hey, don't buy your home. Don't buy it as like your only or primary investment. Save some money. Leave some money on the table to do some other stuff with. Kind of around the table here. is there something that you would say to them like, hey, look, like if you really want it to be a true investment that you don't overextend on, that leaves some dollars on the table to be able to do other things, invest elsewhere, go on vacation and not freak the F out when you're, you know what I mean? What percentage would that be? I mean, we talking 10%, 15%, like, I mean, that you would say, hey, look, this is where you realistically would want to be.
Right. I would personally consult anyone just the 20/20. 20% down, 20% of income monthly is allowable to a mortgage. Mortgage plus property taxes. Yeah.
And for a lot of people, that probably means not buying in California.
Right.
Right.
I mean, unfortunately,
Yeah.
because both coasts, the East Coast, the West Coast, both of them, West Coast, East
You
Coast.
could buy in like Riverside probably.
I don't know.
Bakersfield.
Yeah, but you can go to
Bakersfield.
Bakersfield.
Palmdale.
Yeah,
Bakersfield.
Antelope
Yeah.
Valley.
There are pockets where you could buy,
Kern County, where
but to live in the places that most people want to live right now,
the
that
metropolitan
20%
area.
doesn't always fit in.
Yeah.
Right.
And people are overextending, and that's
Yeah.
why I try and tell my clients, you gotta plan for the good and the bad days.
Yeah, exactly. Like
Don't-
Tony's point, it's Econ 101.
Yeah.
If you don't have 20% down, you don't get to find another way to buy a home. I mean, the banks are making it available, but that shouldn't be your first course of action. It should be, okay, how am I more diligent financially? How can I educate myself financially to one day be able to hit that threshold and buy a house the right way?
But then I'll take it one step further. For a lot of people trying to buy businesses, they want to see that you are a homeowner. They do not want to see you are renting a home
For buying businesses?
for a lot of businesses.
Yeah.
So it's a catch-22. If you're in a rental situation and you're trying to purchase certain things, you're not looked at as well as the average homeowner.
That's true. I mean, I would definitely give you that when I first opened up Afterburn and I got a business loan to help everything get rolling. I mean, probably because everyone thinks it's easy to get business loans.
No.
It's not easy to get business loans. Don't fool yourself. Probably one of the only reasons why that I was able to get one is because because you own a home and then they hold that as collateral.
Yeah,
They
it's a
hold that
financial
as collateral.
asset that they can tap into if for some reason
Yeah.
you
Yes.
default
You go
on
belly
your
up.
loan.
Yes.
Yeah.
Right. So, but if you were a homeowner because you were able to utilize an FHA loan and you paid PMI and you had a 95% loan to value ratio, all of a sudden you're a homeowner, but does that make you eligible to buy a business? You have 5% equity in your home.
Yeah. Well, for sure. And that's the
Yeah. So I mean, like either way, I think someone buying a business, I hope they have the diligence to save $100,000 over some amount
Well-
of time, or else you're not buying a house or a business
Right.
or a home.
Yeah.
Like,
Yeah.
So when you guys say 20, or you said, I think you
20.
kind of both said 20. So your income needs to be at least 20% of the home.
you're
He's saying it should be.
Yeah.
right.
You can get a loan.
Your mortgage and
Higher.
property taxes should be 20% of your total income,
Right.
net
Monthly,
after taxes.
net after
Yeah.
taxes, monthly income.
Or that's how much of your income you'll be spending towards
Got it.
what your property taxes
Right.
and your
That's the-
home mortgage and
Looking at it idealistically, and that's not what's happening here.
No.
In 1985, there was a statistic done in Stevenson Ranch that the average homeowner had a big house, 2 leased cars in the driveway. They ate out on credit cards 4 nights a week, and they had no furniture in the front half of their house.
Wow. Wow. Yeah,
Yeah.
I believe it.
Mm-hmm.
But people live for that American dream. They like the emotional appeal of owning their home, and so they'll do
If
anything
I have a
for it.
big pool and a rock waterfall in my backyard, okay.
Yeah, exactly.
And I think if you prefer to live that style where you're traveling all the time and you're eating out on the time and that's how you choose to spend your money, then maybe home ownership and owning a home isn't the right investment or avenue for you. That's more temporary, short-term outlook on life and where your money goes, as opposed to looking at a long-term investment.
Yeah.
But you said it earlier. If you have a business in Santa Clarita, you have family in Santa Clarita. Santa Clarita is not necessarily an inexpensive place to live, although we are less expensive than San Fernando Valley, which a lot of people don't realize.
Are we
Yeah.
really?
Oh
Or
yeah,
LA.
a lot.
I was unaware of
A
that.
Oh, yeah.
lot. But if you're going to live here, you are better off owning a house than paying the rents that they're calling for in this
Oh, yeah.
in this particular
Definitely,
valley.
Yep.
definitely.
Yeah.
I mean, where I originally grew up in Eagle Rock, a 2-bedroom home under 1,000 square feet is going to run you between $650 to $750. Your dollar is going to go a lot further out here, so it also depends, like, you know, where you live, whether it be within California or outside of California, is where you should look at where that dollar is going to go and how far, like you said, that dollar is going to get you.
Yeah.
Well, right now the average home in Santa Clarita is $541,884. San Fernando Valley, it's $681, $115.
Yeah.
I never would have.
Oh,
I never
yeah.
would have guessed that.
And we're newer, we're smaller community, we're friendly, we're safer.
Most of us.
Yeah.
But yeah, so I mean, Santa Clarita is still a great place to
Yeah.
own. a
Very
home.
family, and I love living out here. I call it the bubble, and I say I'm part of the bubble
Sucked
now.
in.
I've been sucked into the bubble, and I love living out here. My husband, his grandparents moved out here when it was, like you said, it was just all you could see to Ventura, and it's a great community. It really is.
Yeah, I agree. Anything else you guys want to say to everyone before we
Nope.
shut
Reach out to
down?
us if you want to buy a home. It's
Yeah.
a great
I-
investment.
I still
what, let's
think
do that.
you
Why
need
don't
to
we-
buy a home in Santa Clarita Valley, and I am here to help you get that home.
Go around and give your Instagram handle and anything else so they can get a hold of you. Yeah.
You can find me on Instagram at The Income Advisor. That's probably the best way. And yeah, reach out.
Easiest place to find me is on my website, pamingram.com. I'm on Facebook all the time, so that's the other place you could find me.
Cheryl Insua, and my website is insuainvestments.com, and you know, I believe you should invest in your future.
Right on, guys. Thank you guys so much for coming out. It was a good debate. I enjoyed it.
Thank
I
you
think
for having us.
the main thing that we should take away, or that you guys should take away, is mostly that, like, regardless of whether or not you want to make a home a part of your portfolio, is that no matter what, like, don't overextend. Make sure that you can afford what you're buying into, that you have room to be able to make other investments and other wise decisions and not be strapped down and limited. So, but that's it. Thanks for joining. Come back next time. We're going to do time versus money. Cheers, guys. Have a good one.